What if renting your place costs you $1,800 a month, but buying the exact same place jumps the bill to $3,400? In a world of higher interest rates and stubborn inflation, that's not unusual anymore. For a lot of people in big cities across the US, Europe, and Australia, the math has quietly flipped. Renting suddenly looks cheaper month to month, even while everyone says, "You're wasting money if you don't buy." Today, let's calmly walk through one simple story and see what actually happens when someone rents on purpose instead of buying at any price. Meet Alex. Alex earns around $80,000 a year, rents a small apartment for $1,800 a month, and has about $40,000 in savings. No kids, no other big debts, just a normal office job in a big, expensive city. Over the last few years, interest rates and living costs crept up, and suddenly the mortgage quote on a starter home jumped to about $3,400 a month at roughly 6.5%. Alex's friend Jordan earns the same income but decided to buy anyway. Same city, similar home, very different monthly payment. In this story, we'll follow both of them over time, using simple, rounded numbers based on what's been happening in major economies, while keeping in mind that exact figures change by country and by year. Alex and Jordan basically face two options. Option A is what Jordan picked. Buy now at a higher mortgage rate, put the $40,000 deposit into a house, and pay roughly $3,400 a month. Option B is what Alex is considering. Keep renting for about $1,800 a month and invest the $1,600 difference into a simple, boring portfolio each month. Think of that portfolio as a mix of broad stock and bond funds that might earn around 6 to 7% a year over the long term, just as an example, with the reminder that past returns never guarantee future results. The intuition trap is simple. Rent is dead money. A mortgage is forced savings. That can be true over decades. But in high-rate, high-price markets, the price-to-rent ratio is often so high that owning is very expensive compared with renting. The real question becomes, does Jordan's forced equity beat Alex's steady investing after years of higher monthly stress? In the first year, not much changes on the surface. Alex keeps renting for $1,800 a month and automatically invests about $1,600 every month into a simple portfolio. That's nearly $19,000 going into investments in year one, plus the existing savings as a safety buffer. Jordan, on the other hand, now pays around $3,400 a month on the mortgage, plus a few hundred for property taxes, insurance, and basic maintenance. There isn't much room left to invest regularly. Emotionally, Jordan feels proud to be a homeowner. Alex feels a bit behind, but also notices the investing account slowly growing while life still feels flexible and manageable. By years 2 and 3, rents in the city have edged up. Alex's rent might climb from $1,800 to around $1,950 a month, reflecting the way rents in many major economies have risen with inflation. Even so, there's still roughly $1,500 to $1,600 each month going into that boring portfolio, which keeps compounding through a mix of good months and bad months in the market. Jordan's mortgage payment on a fixed rate doesn't change in dollars. That payment starts to feel a little less heavy as income slowly rises with inflation, but there's still not much room for regular investing. The home value moves up a bit, then mostly flattens, which is common after a big price run-up. Jordan is building equity as the loan is paid down, but also starts to experience the reality of repairs and ongoing costs that never show up in simple rent versus mortgage comparisons. By around year 5, Alex has been investing that monthly difference consistently through good markets and bad. With regular contributions and reasonable long-term returns, the portfolio has grown into a meaningful 6-figure balance. The exact number depends on the market, but the pattern is what matters. Steady contributions plus time create noticeable compounding. Jordan's situation looks different. Each mortgage payment slowly shifts from interest toward principal, so more of the payment is actually building ownership in the property. Equity is growing from both sides, a loan that's shrinking and a home value that over several years has nudged higher again as inflation and incomes catch up. Both of them have real assets now. Alex sees liquid investment account, Jordan sees equity inside the house. The big difference is that Alex can move cities easily, while Jordan is more anchored, enjoying stability but carrying more responsibility with the property. Fast forward to roughly a decade. Alex has stayed disciplined, renting, moving once or twice as life changed, but always keeping that habit of investing the gap between rent and the higher mortgage payment. Over 10 years, that adds up to a large amount contributed, plus growth, turning into a substantial portfolio that can be used for a future home, retirement, or other goals. Again, the exact figure will differ by country and by market returns, but the point is that patience and consistency matter more than perfect timing. Jordan, after 10 years of payments, now owns a much bigger slice of the home outright. The loan balance is far lower than at the start, and the fixed monthly payment feels smaller in real terms because salaries and prices have risen. The home itself is worth more than it was when rates were high, thanks to inflation and ongoing demand for housing in big cities. One person has freedom plus liquid investments. The other has stability plus significant home equity. Both chose a valid path. The interesting part is which one lines up better with their goals and risk comfort. After 10 years, both Alex and Jordan have built real wealth, but in different shapes. Alex has a sizable investment portfolio built by consistently investing the gap between rent and that higher mortgage payment. There was no magic here, just regular contributions and time working together. Jordan has a lot of equity locked inside the home. Every payment chipped away at the loan, and inflation quietly shrank the real value of that fixed mortgage. The house also became more valuable over the decade, which is common in many large markets over long stretches, even if prices move sideways for a few years. On paper, depending on the exact numbers you plug in for your country, either Alex or Jordan could end up slightly ahead. In a very high price-to-rent city, Alex's path often looks surprisingly strong because renting stays much cheaper than owning, and the difference works hard in the market. In a more balanced market, or if home prices keep rising faster than rents, Jordan's long-term homeownership can pull ahead, especially with a sensible interest rate and a long holding period. What really drives the gap is how big that monthly difference is, how disciplined Alex is at investing it, how long Jordan holds the property, and what actually happens to local housing and investment returns over that decade. In the end, both strategies can work. The key is matching the approach to your own numbers, your time horizon, and how much uncertainty you're comfortable carrying. So, what can you take from Alex and Jordan's decade-long experiment? Renting tends to work best when buying is clearly expensive compared with renting, when the price-to-rent ratio is high, and when you're not planning to stay put for 10 years or more. It also only works as a wealth strategy if you really invest that monthly gap instead of letting it disappear into lifestyle upgrades. On the other side, buying usually works best when the price-to-rent ratio is more reasonable, your plan is to stay for the long haul, and you can comfortably lock in a mortgage payment that still lets you sleep at night. In that world, inflation often becomes your quiet ally, slowly shrinking the real weight of your debt while you build equity. A simple rule of thumb looks like this. First, check your local price to rent. If similar homes cost 20 or more years of rent, renting plus investing often deserves a serious look. Second, check your time horizon. If you're not reasonably sure you'll stay for at least 10 years, transaction costs and uncertainty can eat away at the benefits of owning. Third, check your monthly stress level. A mortgage that eats your entire budget can quietly push you into more debt, while a slightly cheaper rental plus steady investing can move you forward more calmly. Exact numbers will always differ between the US, Europe, Australia, and wherever you live, and they'll evolve as markets change. But this basic checklist can help you make a more grounded decision instead of just following the loudest opinion in the room. If this kind of slow, numbers-first walkthrough helps you think more clearly about your own rent versus buy decision, consider sticking around. Boring Wealth is all about quiet choices that add up over years, not overnight shortcuts. Subscribe if you want more calm scenarios like Alex and Jordan's, where we follow the money over time and see what really happens. Everything in this video is for education and general information only. It's based on simplified examples and broad patterns in larger economies, not on your personal situation or the latest local data. Before making any big financial decisions, run your own numbers, consider your goals and risks, and if needed, speak with a qualified professional in your country. Nothing here is a recommendation to buy, rent, invest, or borrow. It's a starting point to help you think more clearly.